Torsten, I'm really excited to welcome you here on stage. Professor Dr. Torsten Dennin, he's the CIO of Asset Management Switzerland, professor at the University, it was Dortmund, wasn't it?
Düsseldorf.
Düsseldorf, oh, I'm sorry. I knew it started with a D.
Like Dennin.
No, exactly, fantastic. No, I really appreciate you coming up from Switzerland and giving us a keynote this morning, so thank you so much, and take it away.
Thanks for the introduction. Danke, Kai. So good morning. I was asked to do the presentation in English, also to stretch this just to double time, so I'm just talking a bit slower this morning. Huh? So we do 45 minutes. Yeah. Otherwise, we are like not such a big group. Please welcome anytime with questions or comments to the presentation. Kai already introduced me. I'm teaching economics and finance at several universities in Switzerland and Germany. My wife always says this is my paid hobby because it's education. My practical work is as an asset manager. I'm managing several funds and discretionary mandates in Switzerland. I'm living in Switzerland now for 9 years. I'm then always happy to come back to Frankfurt, my last stage of career where I was working for Deutsche Bank for several years. Commodity markets. My job this morning is to give you a brief overview on the trends in commodity markets. So not only precious metal, not only oil and gas, just the broad picture on the overall commodity markets. And I think the major influencing factors, I've wrapped them in this on this slide. So the corona, the lockdown, what we see now in the Shanghai harbor, the disruption of supply chains. Some people call it already the end of globalization. At least it's a retreat of globalization on that. So coming back to the state level. Besides that, we have the ghost of inflation back out of the bottle, and overall the transition. Corona is one of the important topics here. The transition on the green energy revolution. And this is overall all trends, and all these things are, of course, influencing commodity markets. Not to forget, our friend on the left, so raging maybe the potential of a nuclear war in Europe. This is all something that's shaking the commodity market since February quite dramatically. So it was like 5 to 6 years of severe bear market in commodities. I'm in commodities since about 21 years now. Basically when I started with Deutsche Bank. This year, 2020, commodities are up 40%. Compared to the Goldman Sachs commodity index, the Bloomberg commodity index a little bit less. But anyhow, so many investors asking me, 40% up, 35% up, that means the story is over, right? So the sector did it, equities are down, the trade is done. And therefore, I counted in a little bit longer periods of time. I called it here the catch-up of commodities. When we're talking about the 70s. So this is my privilege as a professor of economics. I like the long-term views on that. So here from the 70s, you see that the equity markets outperformed in the recent years, and the commodities have been their strength in the 70s and the 80s, and now playing the little catch-up. And there's definitely more to come. So the 40% is not the beginning. We are in the moment at this level. So we might stop here, might go here. Maybe we see another spike like we've seen in the commodity super cycle from the demand side. Relatively, it's one of my favorite charts. Favorite because when I invented it, it was copied by several hedge funds and is also circulating through several other publications. So it's in the commodity world, after 5-6 years severe bear market, it's all friends. It's not competitors anymore. So I'm happy to share. What you see here is commodities divided by equities. Means we take the S&P GSCI, commodities, dividing it by S&P 500, means equities. And this is a ratio. And this ratio shows you basically, are commodities cheap, are commodities expensive, or vice versa, are equities cheap or are equities expensive. So you see the three bubble, or like the three red bubbles on the upper side. This is when commodities have been very expensive. So what we just seen here is we're just coming out of a long bear market of commodities.
Very short question, Torsten. Commodities, how is it weighted?
Weighted?
Yeah, what is in there?
The S&P GSCI, good one. The S&P GSCI is basically very skewed to the energy side. I use the GSCI because S&P GSCI, S&P 500, the same index mechanics. S&P 500, everybody knows, probably the 500 biggest equities. Here, the GSCI, it's 2/3 energy, so that means crude oil, WTI, Brent, heating oil, gasoline, natural gas. And then you have the base metals, then you have the precious, and you have agriculture. So overall, commodity markets, but a bit skewed to the energy. So therefore, it's not a wonder that all these three blips where commodities have been expensive have always been times where oil was rising. And oil was always rising first in commodity market booms. And that's what we see now. With the war, oil was up already to 140, 150, coming back a little bit down, now at 110. It's quite dramatic prices still when we look at the fuel stations. But compared to historic side, especially with a high valuation of equities, we're just moving, just starting. And that's a cool one. So therefore I say it's not money that makes the world go round. It's the commodities, huh? Yeah, because commodities are in everything what we use, in everything what we need. And we are back from the so-called new economy to the old economy. I've seen this twice already in the last 20 years. It's like a kind of revenge of the old economy back again. Yeah? But the overall picture, we're talking about globalization, Corona, the disruption in supply chains, the inflation and rising interest rates. But then come the Russian bear. And this is basically where I want to start the story a little bit, to show you quite briefly what happened with the disruptions from Russia and Ukraine. What is it telling us on the commodity markets now? And what is the implications on the medium to longer term? So in the news, in the first level, it's always about oil and gas. Russia is big in oil and gas production, number 3 producer of oil. Germany is the biggest importer of Russian gas. I think we've seen this in press the last weeks quite a lot. But despite the third topic, Russia is very big in lots of the metals. And this is something we've seen, for example, in London at the nickel market. So the nickel market was breaking down on London Metal Exchange. Palladium, platinum, nickel, gold, uranium, yeah, just to name a few. This is the world market share of Russia in these metals. And this was happening to the nickel market. It was, okay, if you're not invested, it's fun to watch. There are lots of cartoons afterwards. But it was dramatic multi-million price move on that when the nickel market broke and there was the short covering. And you see nickel trading up to $100,000 a ton, trading like 15 to 18,000 for most of the last years. So when you try to hedge that, was a nice catch.
May I ask a question to this nickel chart? Can you imagine that the same might happen with gold or silver?
Yeah, more on the silver side, because what happened to nickel is a cornering of a market. The market was catched by a big short position that needs to be covered, and the market was breaking down. I think the gold market is too big for such a move, my impression. But of course, it can happen to the silver market because it's much smaller. Yeah, the smaller a commodity market, the higher the higher the risk, yeah, and the higher the option that there might be a market cornering or somebody with a strong hands in that. We've seen this in silver in the 1980s, yeah, 79, 80, when the silver market was cornered by the Hunt brothers. It's, yeah, I'm a friend of history, so sorry when I'm jumping back a couple of decades. Back to the present, nickel was just like one blips. Every trade was cancelled on that. But what you see here, it's not in the news, especially for the German energy market. 40% of the uranium that is used in power plants across Europe is from Russia and Kazakhstan. So when I said, okay, Kazakhstan is the biggest uranium producer, huh? So we're safe, it's not Russia. I'm not that clever, but Kazakhstan is not Russia, so we are good. Problem is that Kazakhstan is shipping the uranium to St. Petersburg for refining, and then from St. Petersburg it goes to Europe for the nuclear power plants. So when we talking about the boycott about oil and gas, this will be getting the problem. And what you see is on the right-hand side is the chart of uranium prices. It just started to move as well. So the spot prices started to be triggered. You see like historic prices, when there's a spike, it's going up dramatically. Not a problem. So the power plants is not like a fuel or the gas station where you go with a car and you say, oh my God, it's $250. Yeah, no, nuclear power plant, if they're paying like $40 for uranium, 80 or 200, doesn't matter that much. Yeah? But for an investor, it matters. That is a cool thing. Metals, oil and gas. The more dramatic, I just want to note on that, is the agriculture sector. It's always like an ethical question as well, but we see it in the press now. Russia is using the agriculture market as a kind of collateral. Either you're lowering the sanctions, dudes, or in late summer, we are still blocking the ports and the world will starve. That's basically the punchline what I've seen in the press a couple of days ago. Russians are blocking the ports. No wheat and corn is leaving the country. And Russia and Ukraine together are counting 30% of world market exports. So this is not only an investment topic, this is like a dramatic question later in the summer and also like in autumn. You will see the headlines coming up. It's like looking at an accident in very slow motion. It's coming. If Russia is not waking up on that, this will be a big problem. Quickly back on oil. This is the development of the oil market without logarithmics or anything, just nominal prices. We see the Corona crash, where crude oil was trading down to minus $40 and went up to $140. So high swings. Why minus $40 in the Corona crash? This was the time when airlines were grounded, when, for example, Lufthansa was losing like 1 or 2 million per day in earnings. Every plane was on the ground, nobody was flying, home office, lockdown, no trains passing. 2/3 of oil goes into transportation, so the oil supply keep coming, demand was gone, and the price plummeted, and basically the guys paid people to take off the oil. So this is like a situation never seen in the oil market in the last 200 years plus, ever. But now up, because the situation changed from demand side to supply side. Yeah, we're talking oil a lot because it's like a tremendous big market compared to the other commodities. Oil market, $2 trillion in total when you sum it up. Even when we talk about the gold market, the other elephant in the room, yeah, it's the biggest metal market by value. Iron ore, for example, the biggest market in terms of tonnage. It's from Visual Capital, so it's just splendid graphic. I'm just adding the values. And you see like lithium or like the smaller ones, rare earth, they're like tiny markets. Yeah, same what you said on the silver side. Silver is like small market. The smaller market, the more easy to corner it. Yeah? And we are at the frontier. One of the key topics will turn from fossil fuel to green energy revolution. We are oil addicted. Everything is influenced by the oil market, either directly or indirect. Transportation, synthetics, plastics, fertilizers, therefore yields. So it's everywhere, and basically to coming off the oil takes a while. It's not like with a snap. So here, the transition to the green energy revolution comes with a cost as well. It's good for the commodity investors because the focus is shifting away from oil. Yeah, not that we don't need it tomorrow, but maybe in 2 decades, less. But shifts to the metal market. And I think this is why we are all here today. On the commodity side, there are lots of interesting metals used in the green energy revolution, used in energy, in batteries, for special purposes, and the precious, of course. What comes with a green energy revolution? Of course, a demand multiplier for lots of the metals. So when we're talking, like one of the forecasts is like 500 million cars by 2040 running electric. Yeah, I called it So please press no pictures of the next 2 slides because we're not copyrighted, right? I'm a big movie fan, so like the e-mobility Force Awakens, first movie Star Wars, Elon Musk driving the transition on the electronic driving. The Empire Strikes Back, especially when we're back in Germany, like it's not that German car manufacturers can't go electric, what you see here, like the e-tron is a fantastic car, they have a Mercedes, every car manufacturer has some good alternative electronic vehicles already. But it comes with a cost because this is the materials what we need. And it's not only the small battery metals, it's a lot of nickel, it's a lot of aluminium, it's especially a lot of copper what we need if we're going to this 500 million cars by 2040. Short term, this is one of the developments what you see. Lithium prices are skyrocketing. I borrowed this from Der Aktionär, I think from April. Also not the cleanest materials to harvest. Yeah? Because this is how it is sold to the press, or how it is sold to the public. Oil, the bad old dinosaur in the room. Yeah? Besides the guys who are doing the fracking, it's like super clean, but you have this clean-up affairs, you have these catastrophes, you have like Deepwater Horizon, and it's like dirty and old school. No, we want to have the right side, right? We want to have a clean energy. We want to have a wind power, we want to have a solar panels, and like green, everything on green grass. So beautiful. Yeah, but this is the dark truth behind it. Because the materials for the green energy revolution, we are shifting the focus from the Middle East to China. Lots of materials coming from China. And the reason why it comes from China is because we don't care about the environment. So in the moment in the press, we are reading about China and the re-education camps, right? Big topic again, and like some companies are leaving China on that. But China became the dinosaur for rare earth and like strategic elements for the green energy revolution because the US decided in the 70s they don't want to do it anymore because it's bad for the environment. The costs, including the environmental costs, it's too high. Let China do it. And this is the result. And this is like 1, 2, 3 steps to the side, thinking it's not only the cover page of a green energy, it's not only the clean side, you need to imply the whole supply chains on that. Okay, I talked about materials, but of course, we want to talk a bit about precious metal. We're here also for gold and silver, and we want to understand why silver is not performing, right? Not so much. My daughter is 10 months. She's a big fan of silver. It's like a 10 ounces, I think it's Perth mint. That is so heavy. Look, 10 ounces of silver. Yeah, love it. More of that. Why am I talking about precious metal in this context? Silver, of course, is a different story because it's very well used, especially for solar panels in the future. It's a big demand from the industrial side. But of course, gold as a monetary asset, we're looking at money alternatives. We're looking at money, we're looking at gold, and we're looking, for example, at other alternatives like Bitcoin. And we see that everything what is driving inflation today and is trying to put inflation back in the box means what we're discussing, for example, here in Germany now, heating money, right, for heating costs, then to reduce the VAT on food prices, then to get like on the fuel station like a rebate on the taxes. So there's lots of government things to bring down inflation, but the thing is it costs money, right? It's bringing down inflation, that's good. It's shifting from in favor to the consumer, but of course you need the money. The money is basically not from your taxes, it's on future taxes. So the debt burden is getting bigger and bigger on that. And when the debt burden is rising on that, means it's a good case for the precious metal side. So looking at the debt bubble in the US, it's a good specimen here. Germany, in comparison, is quite moderate on that. But you had this D-link in terms of a debt bubble in the 70s when Nixon opened the window not to convert US dollar in gold anymore. And you see from here this gradual shift and then the exponential growth in debt. So this is all public debt in the US, which just hit with the corona numbers more than $30 trillion. Or when you compare it per capita, so per person in the US, that means every person in the US has... Anybody from the US here today? Nah? You? You're Canadian, okay. Otherwise, you would have like $100,000 of public debt on your nose. Ah, fantastic. So in Germany, it's a bit more moderate. It's like 26,000 euro. But it's growing as well. And you see the exponential growth because the government is creating more and more money. The thing is, it's getting more and more unstable with interest rates starting to rise, and they rise with inflation. And this is the case what you see in alternatives like gold. This is the US public debt as a percentage of the economy. What you see here is the World War I and the World War II. And we are in a situation we are surpassing this level of public debt in relation to the economic power of 2 world wars. And everything is adding to that. It's another excuse. We have seen 2 years ago the first attempt to raise interest rates in the US again. We moved close to the 3%, and then we said, it's too much, it's not working. We're taking it back up, we're taking it back down again, right? It was not working. So now we're on the way up again. Equity markets are down 20% because the Fed is thinking to raise 6 times interest rates by 0.5%. That means from 0 to 3% again. 3% instead of 0 interest rate is a huge debt burden on the public debt. And this is basically the case for the precious metals. When you look, for example, on gold, because you can make the same case, for example, with cryptos and bitcoins, but I like to do it on gold because it's like very handy and you can just emphasize like the whole amount of it. When you put together all the gold in the world, that means the gold of the pharaohs, the gold of the Aztecs, the Nazi treasure, the gold of the Pirates of the Caribbean, Johnny Depp, before it goes into divorce, all the gold together. And you put it together in a cube, you get a cube of just less than 22 meters side by side. That's not much. When you put it next to a pyramid, it looks like this tiny black thing, like a human sketch. But this is all the gold in the world. And all the miners here on the conference today and yesterday probably can affirm you, despite their tremendous growth plans, that the industry is growing by roughly 3,500 tons a year. If the price is up or if the price is low, it's 1.5% of supply growth. Question, what do you think the growth of money, euro or US dollar, has been in the last years? More than 1.5%? More than 10%? More than 30%? Exactly right. Money supply growth was growing by more than 30%, both in US and in euro. And gold, when you look at gold prices, they are quite like gold is dollar per ounce. If you increase the amount of dollars, there's like an easy equation, the price of gold needs to go up to compensate. If not, something is wrong in the industry, like in the Ghostbusters song. The long-term gold price, so I have 2 charts on gold and silver and the miners now to give you into the day with a good feeling for the mining companies because they're cheap. Long-term gold price since the 70s, so about to break now to the upside to the $2,000 level. And you ask, why in this scenario you have high inflation? everything is ticking the right boxes. Why we're still at $18.50 in dollar prices? And we tried, I think, 4 times now to hit the $2,000 mark on the technical side. 2,000, a little bit up, down again. And down again, 4 times. Which reminds me basically when gold was surpassing $500 a couple of years ago. So I'm in the industry quite a bit. It was 5 or 6 times gold was approaching the 500, and when it was finally through, it was like 700, 750, 800, approaching the 1,000 within weeks. So very fast. So I think when the $2,000 mark for the next or the other time is falling here, it will be very fast that we see significant higher gold prices on the back of this fundamental news we have. 1.5 years ago, Bank of America Merrill Lynch posted a price target of $3,000. One of the voices in the industry, it depends always on the time horizon, but I think $2,800 on gold is a price target you can count on in a couple of years concerning with this news we have here. And when we look at the gold miners, so the companies active in the gold mining industry, I put here like also again a ratio chart. It makes me look very smart, I know. You're dividing the price of gold to the prices of gold miners. And here I used the Philadelphia Gold and Silver Index. So it's, I think, 22 companies, the big ones. So that means when it goes down, the miners are pretty cheap. And I posted this drum in 2016 because in 2015, the year before, the gold miners were trading at levels compared to the gold as it has been seen since gold was trading at $300. So this was absolutely amazing. So basically, everybody thought gold mining is going bankrupt. Yeah, the gold price is going down, maybe $800,000. Everybody is going out of business. The industry is bankrupt. Therefore, it was so cheap. It was not. Gold prices are coming up. And since then, we're moving up a little bit. It's a volatile chart, but it started to climb. And this is where I hope to see it in about 3, 4, or 5 years, that it goes maybe on 2.2, 2.25 again in the ratio. And this means we are in a gold bull market, and the miners are finally outperforming again, outperforming against the bullion. And on the bull market, it's normally easy to outperform the bullion, because when you're a gold mining company, what happens? You're sitting on a resource. You do a balance sheet once a year when you're a solid company, yeah? Everybody is doing a balance sheet once a year? Yeah. When you do the balance sheet, the reserves needs to be evaluated. And if they're evaluated, for example, at $1,500 gold or $2,000 gold, it's another value for the company. It's a higher value. That's the first thing. So it's basically the book effect. Second effect is the cash flow argument, because when you're producing, you're selling gold ounces. And if the price of gold is rising, you're selling for more money. And the combination of the two is what we call leverage. So in the bull market, when gold is rising, this leverage means that the gold company usually is outperforming by a little bit more than 2 times the gold price. Yeah? But this careful works on the upside and the downside. And this is why when the gold is going down in the bear market, the miners are becoming dirt cheap like here. Last topic, silver. I really don't understand it. This is the gold-silver ratio, means I divide the price of gold to the price of silver, and it shows me basically when silver in comparison to gold is expensive or inexpensive. So the higher this ratio means it's a good opportunity to buy silver because silver is too cheap in regard to gold. So we have a good performance of the gold market, and we have like a devastating performance of silver. Silver is trading $21, $22. Gold is close to its all-time highs, going through them, maybe making new highs, 2,000, 2,500. Anybody has an idea where the highest of the silver market has been? Historically? So now we are $20. Is it $25, $30? 80 to 100. Inflation adjusted 120. So the $60 we see in a nominal term, 79.80, so 40 years ago, translating into $120 in today's prices. So basically, silver can go from $20 to 120 and still hasn't found its old highs. So that's a big leverage. So therefore, people looking at the silver market, because there's lots of potential, silver goes into solar panels. Solar panels is a big industry, rising dramatically in numbers. Even if I see your skeptic face, I know it. Even if an amount of silver shrinks in the solar panels, but the sheer growth of the silver industry, the sheer growth of the solar panels industry, is outweighing that. That's a lot of ounces of silver that goes into that industry alone. And in comparison to the monetary effect,
What is your explanation for the low price? Why it's not rising? Because the industry needs it.
Yeah.
And you can recycle it. So
I refer to my first sentence. I really don't understand it. No, joking.
you can say it could be like this, or is it really totally no understanding?
I was talking with the head of the Silver Institute about that, I think 2 years ago, because silver always was underperforming in that phase. And he explained it to me in the following way. He said, look, Torsten, when people looking for precious metal, it's because they're scared. And they go first on the big ones. Yeah, they're investing in gold because it's the secure thing. Silver comes later in the cycle when the gold market is in a boom. Yeah, and then is following, basically like a Gummiband, yeah? Yeah, and this is still the situation I'm waiting for. You have an answer to this as well?
I don't have the answer. What happened, the silver market is still more opaque than the gold market. So you find out 1 or 2 or 3 years later. So
2 Minuten, ne?
Warren Buffett bought silver. The silver price was blocked at $4 or $5. Nothing happened. And we had a deficit for 3 years. Huge deficit. Nobody understood. And finally one day, people said, well, it was the Indians who were unloading huge amounts of silver. So you see, there's always things happening in the background.
A difficult market. This year, for example, lots of demand comes from the industrial side, from the data. So it's a growth of 20% in 1 year on that. Investment is always a bit tricky. So people go first to the gold, then following the silver. I mean, look at my daughter, like with 10 ounces, she's pretty happy. I can say, it's $250, she can play with it, right? It would be a 10-ounce gold coin, it would be different. I would watch a bit different on that. Yeah, but maybe it follows. If a gold price hitting 2,500 and we are finally seeing silver at $50 or $60, I mean, especially the miners will be very happy and their investors. So this is basically my nutshell on commodity markets. We talked about commodity markets, welcome to scarcity again. It's not only Russia. Yeah, it's the combination of the factors, Corona, green energy revolution, so breaking down of supply chains, retreat of globalization, that makes commodity markets now and for the next years quite interesting. Green energy revolution looks like there's a shift coming from the energy to the metal markets. The metal markets are very small, so be careful. You've seen this, what happens to a small market this year in March to the nickel. Precious metal, it's a story about the debt bubble, the biggest bubble of all times. I think in the afternoon, Mark Friedrich will talk a little bit more about that. I've seen his presentation last week. It's fantastic. So if you have a chance to see it, he has some charts on that as well. Finally, last 30 seconds, a little bit on the outlook. I think this is where we stand today. We've seen 2016, the beginning of a new cycle in commodities. It was like on the brakes because of a Corona. Yeah, but it's electrification, it's the digitalization, it's the e-mobility, and of course the demographics that's kicking commodity markets. Yeah, it's a new cycle, and this is a cycle that lasts for about 10 or 12 years. You can either ask me more in a coffee break, or you can just read it in a book as well. This may be one difference to Mark Friedrich in the afternoon. I have a couple of books giving away for free. He's charging money for that. And I would like to give one to you, because
you could charge money.
because you're early bird. You were here first in the room today. For you?
Dankeschön.
Yeah. I can do that later, with pleasure. Yeah. For you, the book, because you brought to my attention there are still some typos and mistakes in the book. It's not my fault, it's the publisher. Deal, sold. And one for you.
Sold out, thanks.
Welcome. So, if you would like to do me a favor, do like a quick remote comment on Amazon. Yeah, because then I'm breaking the 100 people doing a review on that. Therefore, I conclude that. Happy to take any more questions.
Thank you very much, Torsten.
Pleasure.